the question and answer session using that private chat. Doug, I'm going to go ahead and give the floor to you and let you take over for about the next 45 minutes or so, and we'll go from there.
Sounds good. Well, I appreciate it. Appreciate the introduction, and I actually have I can't see the chat on my side either, so it's going to make it a little bit more difficult. But looking forward to giving the class. We had a great class this morning. Basically, what I'm going to go over here is some of the fundamentals of Iron Condors as an income strategy, and really what we're looking at is what are the fundamentals of Iron Condors themselves. Before I get into the Iron Condors, I'm going to be going over some very basic stuff about options. Now, I realize that the majority of people here are pretty well up to speed on options, but I want to make sure that we're kind of on the same page on a few things, and that especially the people who come along later and maybe see this as recording have a chance to kind of lay that groundwork for what we're talking about. So now, let's get into it and see what we've got. Now, first of all, since we do live in a legal world, I do have to go through a very brief disclaimer. ProEdge Trading Group is a community of traders. We're seeking to educate and inform other traders about strategies, tactics, and possible opportunities for options trading. The topics we discuss are the opinions of the presenters, and they're given for educational purposes. I have to make a point, we're not financial advisors or registered brokers. Nothing in these presentations should be taken as advice to buy or sell securities of any type. Options trading is complex and financially risky. I would highly advise practice any concepts that we discuss using paper trading accounts and safely learn the strategies. When you're ready to actually use live money for options trading, please consult with a registered broker or financial advisor before placing any trades. And the traditional one that everybody loves, past performance, whether actual or indicated by historical tests and strategies, is no guarantee of future performance or success. All right, we have got the legal stuff out of the way. Everybody pretty well knows that, but we need to take a step anyhow. All right, now, this is going to be very basic to a lot of people, but once again, I want us to make sure that the newer people are on the same page and they can at least follow along with what we're talking about. And some of these things that I'm going to talk about are pretty basic to what we're going to be looking at for Iron Condors. Now, options are a contract, and it's a contract that is the right to buy or sell a stock at a specific price during a period of time. Now, this is a very important thing because it's not like a stock. A stock exists, it's a piece of paper, and it's traded back and forth. Options are actually contracts between two people. So new options get created, options go away, and the amount of options in the market goes up and down on a daily basis. The buyer pays for this right, and the seller receives the money for offering up the right. Once again, all options in the market are created by a transaction between a buyer and a seller. The total number of contracts at any one moment is called the open interest in the market. So the open interest is a really interesting number that gives you an idea of how many people are actually buying or selling these contracts at any time. Each unit of open interest actually represents two people, one buyer and one seller, and that's an agreement between the two. So anytime you're looking at open interest, realize that that's actually double the number of people who are interested in that particular option. Once again, basic stuff. It calls the right to buy a stock at a specific price and puts the right to sell a stock at a specific price. The strike price in the options is the price of the stock that the buyer will pay if they choose to exercise the option. Now, most people, when they're dealing with options, don't think about exercising because, for the most part, we're just trading the options themselves. But the person on the other side, especially if you're selling options, can exercise an option at any time they feel like it. Now, financially, it doesn't make much sense to exercise an option until the expiration or right at the very end. But some people choose to do it early. So when you're dealing with Iron Condors, which a portion of the trade is selling options, you do expose yourself to the risk that the other side could execute the option at any time they feel like it. It's not likely, but it does happen sometimes, and I'll tell you what, it really messes up your trade. In the case of a call option with a strike of 35, the buyer has the right to buy that stock from the seller for $35. If the price of the stock has gone above 35, at that point, at any point in the future there, it makes sense for the option holder to exercise their right and get the stock for a cheaper price than the current market. Basically, they can make money on the trade. Same as for puts, just the opposite direction. Now, this is the part that I wanted to get into, and it really relates to Iron Condors. What makes up the price of an option? Now, the price of an option has a couple of components to it, and all of these components add up to the total price that you see in the markets. First component of the option price is what we call intrinsic value. Anytime a stock is trading above or below, in the case of a put, the strike price, then the difference between the strike price and the current price is called intrinsic value. So in this case, we have a stock that's trading for $37. You're looking at a call option, it's $35. $2 of that, the price of the option, is what's called intrinsic value. Now, if you have the opportunity to buy a stock for $35 and sell it for $37, there's $2 in profit built right into that. So automatically, the option price is going to have at least $2 in value. It will never drop below that. If it does, then you could literally buy the option, execute it, and sell the stock for absolutely risk-free money. And that just doesn't happen very often. That would be a very strange thing to see. Now, the second component that we look at in options pricing is time value. Now, time value is actually just a very small part of the options price. And it's not the same as time erosion or theta. We'll get into that a little bit later. But the time value is basically taking into account if the seller of the option didn't sell the option and used his money for something else in a risk-free way, treasury bonds, I guess those aren't terribly risk-free anymore, but you know, the very low interest rate, very safe transactions, what would he get? And these days, that's a pretty low number, 1 or 2% annually. But that adds into the price. So basically, the person has to get something for making this transaction, and that's built in there. The other thing is, the closer you get to expiration, the smaller the time value that's left in the trade. Part of that is called theta decay. I didn't actually characterize that perfectly right, but a portion of that, that is a portion of what we call theta decay, the time erosion of the price. Now, here's the real big thing, and this is what we've really got to understand. Honestly, implied volatility is the #1 thing to understand when you're trading options. You know, it tells you whether the trade is a good trade or a bad trade, whether you've got an advantage or you have a disadvantage in the trade. So understanding implied volatility is a key thing, and it's absolutely a key thing dealing with Iron Condors. So what makes up implied volatility? Well, honestly, implied volatility is the money that's left over after you take out the intrinsic value and the time value. After you take those two prices out, the remainder of the price of the option is all implied volatility. So what is that? It's risk. It's a premium that's put onto the option. You know, just like any insurance company, they want a person who writes an option wants to make money. So what they do is they increase the price of the option so that even if the level of risk they see happens, they're still going to make a little bit of money over that. So that's the added value that they get for writing the option. So the risk premium is added to the price of an option based on the seller's analysis of the chance that the stock will go past the strike before the expiration of that option. So the seller takes a look and says, this stock moves around this much. And based on my personal opinion, I think that there's X amount of risk that that's going to go beyond my strike. And if I'm going to take that risk, I want to receive X amount of dollars. I want to get a profit. I want to protect myself. I want to buffer myself against the option that I'm selling going bad. And I want to make it worthwhile for me to hold that. So if the stock is a very volatile stock, and I'm talking about the actual price movement of the stock, if it's moving around a lot, then typically the risk is high that the price will move past a strike. And the options price goes up, which translates into a high implied volatility. If the stock does not move much, if normally that stock is a fairly slow-moving stock, think something along the lines of Microsoft, boring, then the implied volatility is low. It will just have a very minor amount of implied volatility, and the price of the option will be low. Because the person writing that option knows that they're safe from anything really crazy happening. This is a boring stock. I don't have to worry about this thing jumping $15 against me, and I don't need to be compensated for taking that risk. Now, a couple other things can affect implied volatility in an option. You always have to look at what the upcoming events are. Now, we've talked in the past about earnings events, FDA announcements, any type of event, any type of piece of information that's coming into the market in the future that can drive the price of the stock up and down radically is something that's going to adjust the implied volatility. The closer that you get to one of those events, or the period when one of those events might happen, the higher the implied volatility, because the people who are writing the options, the people who are creating these things, they need to protect themselves. If there's a high chance that an earnings announcement is going to drive a price through the roof, then they want to get a lot of money for taking that trade. Now, all of the things that we just listed up there are all clumped into one description called implied volatility. Now, one of the other things to remember about implied volatility is that implied volatility is not always an accurate prediction of what the market is going to do. Implied volatility can shift around quite a bit. It can be overpriced, it can be underpriced. You know, a couple of examples of things that affect implied volatility in options. Options writers may have written and they're just not interested in selling anymore. You know, then in that case, they'll sometimes put a price out on their options that are very, very high, and if someone comes and wants to buy an option from them, they'll sell it to them, but only for an extremely high price. So that drives up implied volatility. If enough people get in that situation, you basically have a very, very high implied volatility that has nothing to do with the way the price of the stock moves. The other thing is, implied volatility may react to rumors and vague risks in the market. All of these can drive implied volatility up. Maybe there's some basis to them, but honestly, for the most part, rumors are rumors. They don't have a lot of basis. So when the implied volatility goes way up based on rumors, that's a chance for you to sell volatility, to sell options, and make some very good money. Another thing is large hedge funds may be taking protected positions. Normally what they do is they buy up large lots of puts. That drives the implied volatility up on the put side, and that actually translates over, there's a thing called put call parity, that translates over to the call side, because the implied volatility of the puts and the calls has to be relatively close to each other, or there's an arbitrage situation, and that just isn't really allowed to be happening. So that's another thing that could drive the price of the implied volatility up, giving you a very, very high premium on the options. And the flip side, sometimes options traders just want to reduce their positions. You know, they're just getting rid of these things. So in that case, they're driving the price of implied volatility down. Now, this is probably the most important thing. Learn implied volatility. Understand it very, very deeply, because implied volatility is what gives you an edge in the market. Well, it actually tells you whether or not you have an edge in the